Rohr here with an early global view on Friday, September 12th, 2014. It's currently 5:45 a.m. and we're coming to you a bit earlier than usual because we want to make sure we get this up well ahead of the U.S. retail sales number because it's been a very interesting week and we're asking just how buoyant the equities might remain once we see that number today. So what does this all mean to the market activity? And you can see how thin we're getting in September S&P future as the volume really rolls over to December, but the spread there is approximately $8 lower in December. So anything we're discussing on these SEP levels, you can just subtract $8 and you'll have the equivalent trading levels. And coming in this morning, the September contract is about steady at 1997, and not surprisingly, that leaves the December down at 1989. And both contracts, over the course of the past several weeks, starting a couple weeks ago, gap higher on Monday, the 25th of August, for the push up above, choppy and erratic as it may have been, above 2,000 in the lead contract, formed this head and shoulders top we've been discussing for the last several days. And it's as we noted right from the original down break on Tuesday, this is a distorted sort of pattern. Very often that leaves them less reliable. And lo and behold, after a left shoulder that was pretty orderly, a distorted, lopsided head, and a little bit of more prominent right shoulder, the down break from the 1989 area, which took place on Tuesday, did not get any sustained follow-through on Wednesday. By mid-morning, the market was back above it and held up all day, but you can allow for an initial clean-out back above a breakout level, a down breakout, and you might reinstate the down breakout. And after the weak U.S. weekly jobless claims yesterday, indeed, we did see the pressure come back into the market, spending some time early below 1989 again. But by the end of the second hour of trade, it was back up above that level, and the market was pressured into lunchtime back down toward 1989, couldn't stay down, ended up strong, and the fact we're even above the previous trading high at about 1995.5 and finished above it yesterday was a positive sign. Now, what we'll see after retail sales today is another matter, but the problem for the bears at this point is that with the Fed still looking to remain accommodative in spite of what some of the Cassandras are starting to drum up about quite a bit more hawkish and rate hike language in the FOMC decision and press conference next week, Wednesday. If it's weak advanced retail sales, it's going to encourage the thought of more accommodation. We think this bad news is good news is the reason the S&P was able to rally back yesterday. And if it's a relatively good number, then, well, better economic data, how much progress are you going to make putting the equities down on that? The only thing which might have an impact if it's something geopolitically, either out of the Ukraine or out of the Middle East, came along later today that was really upsetting. And we take a look back at the 30-minute chart as well, and you'll notice in each case the pressure that came in back on Wednesday morning was the window for the 30-minute MACD or the 60-minute MACD to slip out below its lower runaway band. As neither did at that time, that's another reason why things are looking a bit firmer. And that's pretty much it for the short-term view of the S&P 500.